Hello and welcome back. Francois Savary, hello.
Hello, Mark.
Thank you for joining us. The Draghi Report. The Draghi Report was published 6 months ago, and people are talking about it ever since, especially in Europe, obviously. To be fair, one of the measures he proposes is to replace unanimous voting by majority voting, which seems like common sense. It should have been done years ago. He wants to boost innovation, combine tax, trade, and foreign policy, and he'd like to reform the capital markets and improve securitization. Which of these are the most important as far as you're concerned in terms of the European economy?
I would say that the most important one is the notion that we need, at the end of the day, to have an integrated capital market in Europe. And that's the key element, because at the end of the day, it means that you need to move forward with the current form of the European Union, economic European Union. You really need to move forward with a banking union, which the Germans have always opposed. And this is something that is quite similar because you need to really create a European capital market. That's the big point of Mr. Draghi, to my point of view, because it would allow free movement of capital. It would allow a consolidation among the banking system. It would allow, because this is also one of the elements of the program, but because the securitization issue, it would allow to increase the common fiscal policy in Europe. And those are the key feature, because you need to have that in order to promote what is calling for, which is innovation, reindustrialization. All those elements depend on the ability really for the capital market to be integrated in Europe.
So this means an integrated fiscal policy. So therefore, exceptions like Ireland and Holland would be negated. They wouldn't exist anymore.
Their system would be different. Again, it doesn't mean that you need to scrap everything that exists, but you need to have a system in which the fiscal integration is promoted. At least you advance. It doesn't mean that everything needs to be scrapped existing, but you need to converge toward a system that is more and more unified.
Ursula von der Leyen has been talking about investment amounts, huge amounts. I've heard 800 billion per year.
Yes, that's the number the European Commission is working on. They mentioned this number, I think it's 4 weeks ago, when they came out with the first lecture and first proposal coming from the Draghi Report, and this is exactly the number they have in mind: 800 billion euro. That's what they have in mind.
I presume this would be raised by a common bond.
That's the big point of the Draghi Report. If you want to follow his lines, you need to go for a common bond. It's common issuance. It means more fiscal power to the European Union, and this is a key element. And don't forget that the Germans have always, up to now, opposed, except exceptionally, to this kind of venture. What is interesting is what is happening with Mr. Merz. You know, Mr. Merz last week has been able to reach an agreement with the German in order to scrap the fiscal ceiling and debt ceiling. And you see that there is an evolution in Germany that is very, very good in in terms of the ability of European Union to move forward with the Draghi Report.
Do you think the Germans would accept very reluctantly, but they'd accept so long as all of the nations started to respect the 3% deficit rule, and therefore some of the economies like France, for instance, would have to contract quite considerably?
I think that if you look at the logic of what is happening in Germany, look at the logic of what is happening in terms of the new world disorder that is emerging. Clearly, I think that you can no more go for, okay, there is a stability pact and there are exceptions to the stability pact. Clearly, the stability pact is not the right pact, and they need, at the end of the day, come out with something that is different. So if the Germans are really going to move forward with the plan, the 500 billion plan of infrastructure, plus the fact that they are going to also scrap military spending from the fiscal debt ceiling, you really see that the fiscal pact is going to be under review in the coming years.
So you're talking about the fact that the debt brake would not include defense spending, and therefore that would not be included within, and therefore they would be able to expand their defense spending as much as they wish, which we've been talking about last few weeks.
Yes, the first 1% will be in the fiscal ceiling, in the debt ceiling, but what is above 1% would be excluded from the debt ceiling. And this is what they are negotiating. And you know that today, in order to be able to build a coalition and to organize what he wants to organize, which at the end of the day is to pass this law and this modification of the constitution very quickly, he needs to do that before the new parliament emerges. And so the socialists, the social democrat, the Christian Democrat agreed on this plan. Now the Green are trying to play the game of finding a better deal in terms of what is happening to the ecology green deal and those kind of stuff. But this is what is emerging. Yes, this is really something that is in a way a new Germany for the future.
Obviously, implementing all of these proposals, it's a few years down the road. Nevertheless, the 800 billion that's being mooted, and by the sounds of it, they will go ahead with it. What is this going to be spent on?
Different elements, innovation, technology. There is, the notion that the European Union is really backward in terms of technology advance, and they need, for example, look at what Macron proposed and the agreement he signed with one of the Emirati country, or Qatar, I think. This is this creation of huge data center in Europe. So now Europeans have understood that they need to catch up, and I think they will finance the creation of national champion on the industrial front. They will finance the Green Deal in a way, because you need to slow down the Green Deal process. So there are different elements in the economy that will benefit from. This is a revival. What Mr. Draghi is proposing is a kind of, okay, let's make a revival of the European economy. We need to scrap the regulation. The red tape needs to be destroyed. We need to invest in innovation. We need to reinforce industrial production. We need to invest in infrastructure. All those elements are going to benefit from this plan.
Coming to the internal capital markets and securitization, what is being proposed and what are the changes necessary? How is our investment world going to change in Europe in the next 5 to 10 years?
If you have an integrated capital market, you are like the United States of America. Okay. What is very clear, it's easier. It's much easier for you to finance your debt. It's much because the liquidity at the depth of the European debt market is quite limited for the time being. So it would increase that. It would mean that you would have more financing coming from the private sectors and coming from the financial sector to support economic growth in the future. It would also mean, and that's something that is very important, that you need to have banks that are big enough to support this development. And this is the reason I mentioned, at the end of the day, the banking union is also a key part of the Draghi plan, because you need to have the ability for an Italian bank to buy a German bank, to create a European champion on the financial system, and so forth. So it's very, very important. It could be a game changer.
Coming to financial markets now. A month ago, we did a video called "Take Profits on Your Equities, Reduce the Weightings," and you recommended to rotate from US into European stocks to reduce the weighting of equities in portfolios. And you mentioned pharmaceuticals, financials, small and mid caps as some of the sectors that you thought could be benefiting from the next few months. We've had a big sell-off just yesterday, but it's following a gradual sell-off for the last 2 weeks, something like that. Assuming somebody has followed your recommendations, should they be sitting on their hands now? Should they be waiting? Are we starting to see value? Some of these markets are already in correction territory, which is about 10% drop, but from the highs. But could they go to 20% correction?
Okay, first element, all the point that you mentioned about the recommendations, some were right, some were wrong. But there was also a basic recommendation that I gave at the time, which was, okay, you need to diversify and reduce your exposure to technology because it was overvalued, and that was something. And that was the reason why I mentioned that. And this is a move that we promoted in December. We increased the European exposure by reducing the technology in the US. The weight of Europe increased by. Okay, different elements. The political and global situation has not improved in the course of the last 2 weeks. The movements in the US coming from I impose tariff, I postpone, I go back. You have more and more economic numbers coming from the US, which are telling you that there is a slowdown. It had fed into a kind of recession fear in the market. First element. So I would say the fundamental condition was, okay, nothing is going to happen to the US economy, Goldilocks scenario. 15%, 14, 15% EPS growth in 2025. Those two elements are getting away because at the end of the day, people are readjusting their expectation for the US economy. And now EPS growth is around 10% expectation. So it's a significant move. So I think that those elements are very important because it begins to tell you, as there is a repricing of those elements, that there could be some value in equities. The second element, VIX, the volatility index, is at 28. It has gone out of its historical range. And you have some elements there that are telling you that the stress or the kind of panic of individuals is getting higher and higher. Retail investors have cut the position very significantly, and their optimism is very negative, very pessimistic about the situation. All those factors are telling you that I will not answer with a definite answer, but we are getting close to a point where there will be some opportunity on the market. My target was for 5,500 on the S&P 500. We are getting close to that. Yesterday night, we tested the 5,550. So I am inclined to consider that maybe there are some opportunity that will emerge in the coming days.
Are there any sectors that you're looking at particularly?
We had reduced it quite significantly the technology sector. I think that you have currently some kind of wave, which is also connected to DeepSeek. But there is really now a disregard for American technology stocks. I think that it could be a good moment maybe to take some position back in this area. Even if it did not work, I still believe that there will be some opportunities in small and mid cap because I don't think that the international trade environment is not going to improve significantly in the coming months. I think that the Trump administration is going to try to move forward with the tax cut. And there is one final element that you need to have in mind. On the 14th of March, in the US, there is a risk of a shutdown in the US administration of the government. Don't forget that this week is going to be key because there is a vote by the Congress that needs to open the door to avoid this kind of shutdown. So you are not under pressure to get into the market right now.
One of the other calls you made was the US dollar. You called for the US dollar to weaken, and you thought it's strengthening after the inauguration of Donald Trump was a false breakout. Lo and behold, the dollar has weakened. It's gently creeping back up to 110. You're having a good day this morning, aren't you? And so 110. Is that the, we should say support, shouldn't we? Is that support for the US dollar against the euro?
It would be a resistance. Okay, I would say I think that the move that we experience now, getting close to 109, is quite huge. Even against the yen, another call that I had, where the yen is at 146, 147, the yen has improved quite significantly. It's connected to interest rates. You need to have more visibility on the economic situation. I think that what you can say is the first element I would say, I don't think that we are going to see parity against the euro in the coming months. Many houses expected that level to happen in the first half of the year. I think that you can get rid of that. I think that we need some consolidation. Don't think that we are going to see a huge appreciation of the euro against the US dollar from current level. I think that you can imagine 110, 112, but otherwise, I don't see any reason to believe that we are going to go to 120 in the course of the coming year. The main reason being that don't forget that what happened on the bond market in Europe last week was huge. When you see 40 basis points increase in the German Bund, this is a factor that supports significantly the euro. I don't see that we are going to see 40 basis points more on the 10-year bond in the coming months. So I think that a lot of the repricing of the US dollar has been made.
Okay, Francois, is there anything you're looking, apart from that event, is there anything you're looking forward to this week?
CPI and PPI in the US, because at the end of the day, what happened in the course of the last months or last 6 weeks is moving from a system where people were fearing inflation to a system where they are fearing now a recession. Let's hope that the PPI and CPI number will reduce the risk to see a stagflation in the US. And that would be the best development that we could see because people need to digest the fact that there is an economic slowdown in the short term. What we need to see is that inflation still remains under control because otherwise it could be a dangerous statistic for the US equity market.
Thank you very much, Francois. I think that's all we got time for. I look forward to seeing you next Monday.
See you next Monday.
Bye-bye.
Bye-bye.